Good evening, all. I am Jitendra Kumar Patle, Product Manager, Commodity and Currency at ICICI Securities. On behalf of ICICI Securities, I welcome you for this live webinar on Currency Outlook for year 2023. We do periodic webinars on various topics, including currency and commodities. Similar to this webinar, last week itself, we had one webinar on Commodity Outlook for 2023. And links of all these related webinars are available in your YouTube description box. So today we will discuss currency outlook for year 2023. Due to multiple factors like global inflation, geopolitical tension, calendar year 2020 was full of volatility for all global currencies. And we have seen in 2022, rupee depreciated by more than 11% against US dollar. And it has made all-time low and crossed 83 level first time. So I'm sure all our viewers would be interested to know outlook for calendar year 2023. So in this webinar, we will cover outlook for USDINR for year 2023. In addition to that, we will discuss outlook for other major global currencies like Euro, GBP, and Yen, Japanese Yen. We will also cover key events and major factors which will affect global currency market. We will also understand expectation of US Fed on interest rate cycle and outlook for dollar index. I know it's very difficult to cover all these aspects within next 30 minutes, but we will try to cover as many as possible. So that's why we have posted one detailed presentation, detailed reports on currency outlook 2023 in ICICIdirect non-logged in section. Also, at the end of this session, we will post the link of report in our chat box. Meanwhile, if you have any queries, you can post in your chat box. We'll try to cover one by one at the end of the session. So to understand this about the currency market outlook, today we have Mr. Saif Mukadam, Research Analyst, Currency and Commodities at ICICI Securities. Saif is MBA Finance from Mumbai University and have vast experience of more than a decade in the research area. So with this, I would like to welcome Saif. Saif, over to you.
Thank you, Jitendra. Thank you very much. Good evening, everyone. So without wasting time, let's start with the presentation and the outlook for 2023. Let me share the presentation with you first. I hope you can see the presentation.
Yeah, it's visible. You can make it a full screen.
Yeah, sure. Okay. So let's start. This is just a synopsis, or you can say just about what is there in the report. We are expecting rupee to appreciate back to 78 levels. Dollar index, we expect it to tumble to 97 due to some of the reasons like moderating inflation, which may convince Fed to consider cutting rates. Rupee to appreciate back to 78 levels is because Indian economy is exhibiting resilience to external headwinds. Euro, we expect it to slip further till 0.98. It should go below parity again, majorly because euro is expected to slip into recession on ongoing energy crisis. And pound, we expect to plunge till 1.10. That is because UK economy is to suffer deepest recession compared to its peers. Before we go ahead with the 2023, let's see what happened in 2022, because 2022 was an eventful year, you can say, because we saw a Ukraine war, Russia invading Ukraine. Then we saw a surge in inflation and a lot of monetary policies coming up, at tightening monetary policies, you can say, across the globe to control the inflation. So what has happened, how it has impacted rupee in 2022 was the rupee depreciated drastically amid geopolitical tensions and aggressive monetary tightening across the globe. We saw rupee depreciating like more than 11% in 2022. Then geopolitical uncertainty, which was caused due to the war in Ukraine, led to the energy prices to increase. The surge in energy prices led to rise in inflation and even impacted our current account deficit. RBI took a lot of measures to tame stubbornly high inflation. Since May, we have seen that it has hiked the repo rate by 225 basis points, taking it to 6.25%. And on top of it, we saw FII sold close to $16 billion in equities in FY22, which had an impact on, or you can say severe impact on the Indian rupee. Uh, we saw this on the rupee front. Now let's see what happened in the yields. If we see major country yields, they recovered in 2022 majorly because of the monetary tightening. Major central banks across the globe we saw has adopted the monetary policy tightening to combat soaring inflation. Like US Federal Reserve, it started tightening its monetary policy by raising rates in March 2022, and then it started shrinking its 9 trillion asset portfolio from June 2022. Then we saw recently BOJ raised its effective cap, or you can say the last year in 2022, BOJ raised its effective cap on 10-year government bond yields to 50 basis point from 25 basis point. So this was the synopsis we can say for 2022. Now let's see what we expect in 2023. In 2023, there are multiple factors which will be in the favor of rupee appreciation, which we expect. Uh, First of all, let's see, we expect rupee to in the range of 84 level and to 78 levels. We expect rupee to appreciate back to 78 levels as it is facing a strong resistance near 84 in the coming months, because Indian economy is in a better shape compared to its peers and is able to withstand any external headwinds. As I've told you, in 2022, we saw depreciation in Indian rupee by 11%, but on RER basis, if we see, the rupee has performed fairly versus the basket of currencies, despite the monetary tightening. Then we have relatively high forex reserve, which we can see should provide a cushion to during such kind of economic slowdown or during such kind of uncertainties. And to top of it, or you can say on top of this, there is a softening of the crude oil prices, which will help us to lower the import bill. So that is again positive for the Indian rupee. And also, if we see the growth prospects in other economies are not so good or expected, so due to which we can see a drive of FI inflows in India. So let's see how Indian economy is performing right now. If you go to see the Indian economy or the GDP chart, we can see that India to remain fastest growing economy, it is exhibiting a resilience to the external headwinds and is expected to forecast, or it's expected to be in better shape compared to its peers, and expected to grow by 6.9% in FY23. And on the other hand, if we see the inflation, which has already started moderating, and we expect it to remain in the RBI comfort zone in the coming year, a improvement in the global supply chain, and as a higher interest rates, which should take effect, which the RBI has done. So that will have an impact on and the inflation should start moderating. And on the other hand, if you see the Indian basket of the crude oil has hit to 10-month low in the to 88.6 barrel in November. Further, India is also likely to continue buying discounted Russian crude oil. And if we see the share from the oil imports from Russia has crossed 20%. So that is again a big thing. And currently, if we see the current account deficit was at 2.8% of GDP in the first quarter and around 4.3% of GDP in the second quarter. And we expect CAD, current account deficit, to remain under 3% for the next year. World economic scenario, if we see, it is expected to show sluggishness, and due to the tightening monetary policy and the high inflation, like whatever the tightening monetary policy has been done, so the repercussion will be felt. So we can see a slowdown in the global economic growth, and due to which the exports may get hit up to a certain extent. But the decline in the crude oil prices and the availability of the discounted oil from Russia should keep our import bills lower. On top of it, if you see this year, it moved pretty higher after Fed started tightening its monetary policy. But in this year, we are expecting the dollar index to come down till 97. And if we see, we have already started seeing it is losing its strength. And due to, like, in the coming month, as Fed is likely to take a backseat. I mean to say a backseat is like maybe the peak of interest rate hike is nearby. We can say around 5%, which we are expecting, and maybe there could be a pause in the rate hike in the first half of the year, and there could be a cut in the hikes next, like the cut in the interest rates next year as well. Sorry, in the next half of the year in 2023. So that should be like put down some pressure on the dollar index, and we can see the strong resistance near 110 levels for dollar index. Now, the major factors that drove the dollar index in 2022, like geopolitical uncertainty or monetary tightening, have been priced in. Now, all the focus will be where, which will be on the Fed stance on monetary policy. So, easing price pressure, if you see inflation pressures are ebbing, and again the looming recessionary fears may force Fed to pause its rate hike and may even cut rates by the end of the year. That's the reason why we're expecting dollar index to tumble to 97 levels. On the economic front, if we go to see the economic growth is decelerating. US real GDP growth forecast is around 0.5% in 2022 and 2023. If you see the Fed commitment to restore the price stability, I mean to say combat the soaring inflation, it could cause a slowdown in the economy and also raise the risk of recession. If you take any data, say manufacturing or servicing or housing stats, building permits or existing home sales or retail sales data, all are showing sluggishness right now. And if you see the manufacturing and the services PMI have contracted, and that is showing like a slowdown in the economy. And if you even see the US housing market is facing a tough time due to the fastest rising mortgage rates in decades, and the housing market has entered a sharp slump after the Fed started raising its borrowing cost. So the economic situations, if you go to say in US, is sluggish, or it's showing too much of slowdown. And on the inflation front, if you go to see, the US CPI inflation has come down drastically from 9% to 6.5%. So that is showing a moderating in inflation or the ebbing price pressure. So this should provide Fed some room to raise rates not too high as previously feared. And in the coming year as well, we expect inflation to remain subdued as the economy cools down and the supply chain disruption continues to ease. Whereas on the other hand, we expect unemployment rate to rise again and may rise to back to 5% in the coming years. So that will be negative for the economy, or you can say only the positive point for this would be looking at this data. U.S. Federal Reserve may pause its interest rate by the first year in the first half of the year and start cutting the rates by the second half of the year. So that will put downside pressure on the dollar. This is what we are expecting in the rate cut may be seen in the second half of the 2023. And as I've already mentioned that we expect the interest rates to rise only till 5% in the first quarter, and then there should be a pause. If you see the US yield curve, it is showing an inverted yield curve. So that is a red flag because it shows a recession, a looming recession is looming. Recession is looming over here. So that is again should be a supportive point for Fed to consider to pause a rate hike. And we believe the Fed may change its stance considering the weakening economic conditions and may look at the possibility of cutting rates in the second half of the year towards 4.5%. So this was about the dollar index. Dollar index should come down. Now let's see about how euro is going to perform. We expect Euro USD to slip below parity, and the reasons behind Euro coming down to 0.98% in the coming year is ongoing energy crisis, global economic slowdown, and tighter financial conditions are dragging down economic activity in the Euro area. And on the Euro INR front, we expect Euro INR may hold the resistance of 91 and slip back to 83 levels. Again, the series of disappointing economic data from Eurozone signals that the economy is already facing a sharp slowdown. Additionally, elevated inflation will continue to erode purchasing power, while soaring cost pressure is expected to curb the production, especially in energy-intensive industries. So there is, I don't see anything, or like we don't see anything too much of positive in the euro right now. Euro area is economy is expected to be on a slowdown side, and the elevated inflation should erode the purchasing power of the consumers. So that is again negative for the euro currency. On the economic front, if you go to see, the euro area economy is forecasted to show a sharp slowdown as ongoing energy crisis and the elevated inflation or global monetary tightening or the slowdown are dragging the economic activity downside. And the inflation is elevated right now, which is hurting the purchasing power of the consumers. And even the central bank expects the inflation to fall to the medium term target of 2% in the second half of 2025. So there is a chances that it may remain elevated, and the elevated inflation will force central bank to keep tightening its monetary policy despite of the recessionary fears. On the data front, again, if you see the euro area composite PMI data show the business activity contracted for 6 consecutive months as the consumers cut the spending, aim surging inflation. On the largest economy front, if you to see in the euro area's largest economy, that is Germany, is also likely to slip into recession. As per the bank, the economy is forecast to contract by 0.5% in 2023. And if we see any data from Germany, like PMI services data, services PMI data, or the German investor sentiment, that all are deteriorating consistently. And that is the concerns, because of the concerns of energy crisis would collapse, would cause economic collapse. So overall, the data perspective side also, we can see the eurozone looks to slip into the recession, which is showing majorly signaling that. So it is overall negative for the euro. um, on the yield front, if you go to the spread between the US and the German 2-year yield bonds is narrowing, as ECB is likely to continue with its rate hike to control inflation, whereas US Fed has limited room to continue with its interest rate hike, because European Central Bank started late to start to tighten its monetary policy, whereas Fed has started before that. So because of which there is a space for European Central Bank to increase the interest rate, whereas the US Federal Reserve have the limited room. And we expect European Central Bank to raise its interest rate, three key interest rates, by 100 basis points in the coming year. Now let's go on pound. If we go to see, we expect British pound to plunge to 1.10 levels, and in the coming month, as British economy is forecasted to contract in the coming year and face the risk of longest recession. Additionally, concerns over double-digit inflation and swelling current account deficit in UK will hurt the pound. On GBPINR front, we expect GBPINR to face a strong resistance near 104 levels and may plunge back to 91 levels in the coming year. If you see, the Bank of England was the first bank to increase the interest rates and has aggressively increased the interest rates in 2022 to control the inflation. Now, what has happened is, because of the rising borrowing cost, has started hurting the households who were already grappling with the cost of living crisis. Now, BOE rate hike to control inflation even into recession will do more harm to the currency rather than boosting the currency value. Now, just see, if we can see from the charts, the UK economy is facing the risk of longest recession. We can see the industrial production on the downside, retail sales declining for 8th consecutive month. We can see the UK economy is forecasted to shrink in 2023 due to sharp decline in household spending. Higher energy and the food bills are putting pressure on the households. A cost of living crisis will continue to hurt consumer purchasing power. BOE has also warned about the significant pressure in household and businesses due to higher inflation and borrowing cost. So that's what I have already mentioned, that because of the higher borrowing cost, it is facing a lot of pressure on the household spending. So that would be a negative for the economy, and that ultimately will have a negative impact on the pound. Again, if you see, the Britain's factory output is falling at a fastest rate, severe cost pressures and weaker demand for the goods. On the central bank side, Bank of England, like I've already mentioned, it was the first major central bank to start its tightening its monetary policy to combat soaring inflation. BOE remained aggressive again in raising interest rates in 2022, but is likely to slow down its pace of the rate hike and pause the tightening in 2023. We expect Bank of England to pause its rate next year, this year, after raising it to 4%, as Britain is already facing the risk of longest recession. Further rising borrowing cost is hurting the households, which we have already discussed, who are already grappling with the cost of living crisis. So overall, if we go to see, the Bank of England is expected to pause the rate hike in 2023, and overall, all the factors which we saw is negative for the pound. So just to sum up, if you see USDINR, we are expecting to appreciate back to 78 levels, because Indian economy is resilient to the headwinds, and we have pretty good amount of forex reserve, comfortable forex reserve. Dollar index is expected to come down, as the Fed is expected to pause its rate hike in the first half of the year. Maybe it may increase by till 5%, and by the second half of the year, we may see rate cuts by the US Federal Reserve. European Central Bank is expected to increase the interest rate by 1% in 2023, and the euro is expected to come down below parity to 0.98, and Bank of England is expected to pause its rate hike in 2023, and we expect the GBP USD again to come down till 1.10 level. So that's it from my side. Thank you very much. Over to you, Jitendra.
Thank you, Saif. Thank you for your detailed presentation. I think we have received a couple of questions in queries in chat. I will just read out one by one. Yeah, the first query is from Mr. Sam. You say dollar index to go to 97 and also euro below the parity of 0.98. So which basket will pick up?
I did the question. Which
Yeah,
currency basket will pick
basket
up?
will pick up.
Um, basket will see. Frankly, if you go to see dollar index is looking, we are expecting it to come down till 97. That is which I've already mentioned the factors. You may see some upside movement in the euro, but overall, I see that euro may bounce back a little. But you should use a rally in euro USD to give a shot. And because we are expecting it to come down to 0.98, because we may see some rally in euro. That is because Bank of European Central Bank is expected to increase the interest rates. But as I've already mentioned, the higher borrowing cost will always have a negative impact on the economy. So ultimately, some or the other way, it will come down. So use a rallies in Euro USD to give a shot.
Okay, thank you, sir. One more query from Mr. Sam. He's asking, do you share daily research recommendation? So just I wanted to answer this question.
Sure.
Yes, definitely. We share the daily recommendation, daily intraday recommendation, live recommendation that comes through mobile notification or our tool I click to gain page. Also, we provide a daily one PDF report at morning around 8:30 a.m. that get posted under the logged in section, non-logged in section. You can get there on currency page. Apart from that, daily, the weekly, monthly, and yearly outlooks comes. Yeah. One question from my side, Saif.
Yeah, sure.
You explained about the outlook of currency, global market, but what would be the major event or major factor in this particular calendar year for
Yeah.
currency market?
I got your point. Okay, that's a good question. See, the major event you can say for the year would be US Fed rate hike cycle. How US Fed is gonna react to this year again, where a lot of see they have all the bank of or the policymakers are expecting it to go beyond 5%, like 5.25%. Median estimates is around 5.1%, but the market is expecting it to remain below 5%. It's around 4.9%. So we have to see how the Fed is gonna take the stance for the interest rate, because already we can see the economy is facing the heat of the rate hike. All the economic data are coming at a very sluggish pace. So the major factor or major event which you need to see is US Fed rate cycle.
Okay, thank you. Sep, there are few more queries
Sure.
in chat. I think one is generic. Are you running any course to educate investor? So, definitely means we are doing this kind of webinars on periodic basis every month. We have the webinars. So I request Mr. Charan Singh to just follow our YouTube channel, ICICIdirect, and you can get the notification and you will get to know about these webinars. You will get the lots of insight information about market, product, research from those webinars. One query from Mr. Manish Agrawal.
Yeah.
You mentioned that GBP will depreciate to 1.1. So
1.1.
how the USD index is projected at 97?
Yeah, that's what I have already strategy. I have mentioned that the dollar index is expected to come down is because of the Fed stance, for how the Fed is going to take the stance, and it is already into like sliding. And when we have released the report, it was at a higher levels, and it has already come down to 101. So already minimal basis is left. So there could be a chance that the pound, like the dollar should come down to 97, and the pound on the other hand, you are saying like if dollar index is coming down, how the pound should also come down. So there are times when it does not follow the trend, or you can say it moves in tandem. That is because that's already mentioned, the major reason for the pound to come down is the recession, which is the fears of the recession, for a longest recession we can see looming recession. And the housing households spendings are getting impacted because of the higher borrowing costs, so the economy is not doing so well. So that's what I have already mentioned, key instead of Bank of England raising its interest rate should do much better for the currency, but it won't be doing helpful for the currency, but it will have a negative impact on the current currency because of the higher borrowing cost. So that is a major reason why pound should come down to 1.10.
Yeah, thank you. Thank you. Understood. One more follow-up question from
Yeah.
Mr. Manish. India export are down. So how come INR will appreciate to 78? I think you given the lots of matlab,
Yeah.
justifications, reasoning, dollar index
Yes.
and everything. Once again, if you can recap.
See, exports are down. I accept it. There's no doubt in that. But there is a chances that our imports will, which have majorly said that import bills will be lower because we are buying, trying to buy the cheap Russian crude oil price, from the Russia, the crude oil. So that will lower our import bills, and that's how our trade deficit will be in control. And another thing which I've already told, that we have a forex reserve which is at a comfortable level. So that will be again supportive. And on the other front, we have already shown in the chart that the pharma, IT, information technology exports don't get hit much. They always show a resilience during these such times as well. So that will be also a silver lining for Indian rupee, you can say.
Yeah, yeah. Thank you, Sep. Yeah. One more question from I think Mr. Mohan. How to trade in Nepali currency index? But I think at as of now in Indian exchanges on NSE or BSE, we don't have the other currency pairs like Nepali currency index. So as of now, we can trade in USDINR, GBPINR,
Right.
EURINR, and JPYINR, which are the four most liquid pairs on Indian exchanges. Yeah, I think we can wait for I think 10 seconds. It's almost 28 minutes. We have the 2 minutes. We can wait for a couple of seconds or minute, and then we can conclude. Meanwhile, I have posted the link of detailed report which Saif was projecting. So that report is posted to the link. I request all our participant viewers to go through this report. This report is also available on ICICI Direct non-logged in section. You don't need to log in also. Just to visit ICICIdirect .com, go to the currency page. Under that there is a product section. On product page you will find the under report you will find the yearly report, along with the daily, weekly, monthly reports. So with this you can get the detailed report. So Seth, I think we don't have the further queries. uh, Thank you for detailed presentation on currency outlook for year 2023. For viewers, I just wanted to recap the important points from your presentation. Uh, as an Indian citizen, the most important outcome for me from this webinar is rupee is expected to appreciate back to 78 level, which will be the very critical for our economy as well as the importers. So that was the key outcome from my for me. Other important other key points I think you mentioned moderation in global inflation, which will lead to the cutting interest rate in second half of the year, definitely. But that is expected again. Then a dollar index may tumble to 97 level, and due to expectation of recession in eurozone, you said that euro is expected to slip further till 0.98 level. Last point I can read out, that is the due to the slowdown in US economy, pound is expected to jump till 1.10 level, and I think pound yeah, so 1.10 level. So these are the few key points I have noted from your presentation. So once again, thank you, Saib, for this detailed presentation. I would like to sincerely thanks all our viewers for taking time and for your valuable time and watching this webinar till end. You can visit description box of this YouTube videos for more product and research related webinars. I think now we can conclude this session. So thank you everyone. Thank you very much.
Thank you, everyone.